Welcome everyone, my name is Ben Smith. I'm the Small Business Center Director here at Blue Ridge Community College, and it's my privilege to talk to you today about the income statement. So what is the income statement? Well, the first thing that we want to mention is it's a financial overview, and it gives us a better understanding of the numbers behind the profitability of your business. So the income statement, also known as the profit and loss or profit and loss statement, is a crucial document that reveals the profitability of the business. Not just how much money you've made, not just how much you've lost, but what is the balance between the two, the profit of your business. So it is a financial storyteller. It paints a picture over a period of time, summarizing your revenues and your expenses over that period of time. For most people, that's January through December, their fiscal year, but fiscal years can vary. But it is a over a period of time report, as different from the balance sheet, which is a snapshot moment in time. So it's a key tool for accessing and better understanding your financial profitability in the organization that you are a part of, your business. So what are the components? The components of an income statement. Let's break it down. So the income statement consists of three main components. You've got your revenues, you've got your cost of goods sold, and you've got your operating expenses. So when you look at those three, they really together help paint that picture of what your business's financial performance is. So when we visualize revenue, what are we looking at? What does revenue really mean for a business? Well, it means the money that a business earns conducting the activities, the operating activities that it completes. So it's earned income, it's revenue, money that's made, whether that's the product of sales being sold, completion of sales, products, or of service fees associated with completing a task or a service for somebody. So this is your top line. The revenue is the top line of your income statement, and it's the starting point of your financial story. Next up, we look at costs. No, I'm going to start over.
Yeah, my apologies. I see. I can look at it here too, and I just was setting that up. That's what's doing.
So it actually records directly to there too.
No,
or
it doesn't. No, it doesn't. It's recording. It's recording.
But you're seeing it.
But I can see that it's recording, so I'm just verifying. That's all.
Cool. Good deal.
Sorry.
It's all right. Okay, here we go. So when we look at costs and expenses, the next portion of the income statement, we're going to look at cost of goods sold, also known as COGS. And that includes direct production costs, anything associated with the actual production or the delivery of that item, that product or service to your customer. So that is raw materials associated with building, say you're building a toy, and that toy has to have widgets associated with it. Say it's a truck, a toy truck. Well, it needs a front fender piece, and it needs a tire, and it needs a couple other different items, little toy widgets that go into it. Each one of those widgets is a part of the production cost of developing that item. So that's a cost of goods sold. Also a cost of goods sold is the labor that goes into actually making that, if you're hiring someone directly to do that. So labor and the product itself for that cost of goods sold item. The cost of goods sold item can also be the labor associated with completing a service like cleaning somebody's house. So cost of goods sold, and then on the other side of your expenses, you've got operating expenses. So operating expenses, those are a little bit more high-level expenses, things that are going to be associated with actually completing and paying for things that are due every month. Maybe you've got utilities that are due. You've got to pay any outstanding loans associated with the business. You've got marketing expenses, so salaries for employees or for yourself. Anything that is top level that you're going to have an obligation to that's ongoing is an operating expense and not a cost of goods sold. So when we look at net profit is really the combination of these three things: revenue, cost of goods sold, and operating expenses. And the mathematical equation for that is actually going to be net profit equals revenues minus cost of goods sold plus operating expenses. So anything that's left over from that equation of revenue minus your expenses and cost of goods sold and operating expenses, is your net profit. And that's really what establishes you being able to have profitability in the business. And it's a really good sign for a lender. So if you're a business that has net profit and you've shown that for the last 2 fiscal years, a bank is going to be much more likely to want to loan to you because you've got the financial position, you've demonstrated income in a positive way over the last several fiscal years, and banks like to see that. Another reason that you want to keep an eye on your net income is if, for example, you're trying to not necessarily go to a lender, but maybe you're just wanting to reduce your tax threshold at the end of the year. Actually bringing your net income down to the lowest value while still paying yourself a salary is actually probably the best thing that you can do, to have either a zero or a very low net income. And that allows you to have a low tax basis for actually having to pay out your taxes at the end of the year. So depending on your strategy, if you're trying to access financing, you want to be able to demonstrate net income as a positive number, as high as you can make it. But if you're trying to pay lower taxes, which is oftentimes a business strategy, if they're not necessarily in a growth phase, they may want to bring that number down. So depending on what your goals are and where you're at in your situation, you may end up doing 2 different things. So looking at trends for an income statement, the real power of this statement is analyzing the trends. And so, we want to say, okay, what's happening over different months, different periods of times? What are the patterns? What are the strengths and the opportunities, maybe some weaknesses in the business that we want to be able to address? And so one of the primary things to look at is looking at debt and interest payments. If you've got debt that's outstanding that has a high amount of interest associated with it, maybe you've taken out credit card debt because that was the easiest thing that you could gain access to during a specific period of your business cycle and early in your business life, and you didn't have access to other kinds of loan options or funding options, you want to be able to pay that off quickly. And so what that oftentimes looks like is maybe refinancing that into a different loan option, maybe a line of credit or something else that would be more beneficial to your business situation where you're at. The next thing that you really want to look at that your income statement can help you analyze is what kind of operating expenses, marketing costs, administrative costs, market research costs are you paying for now that you could potentially bring those costs down. Maybe you don't necessarily need to pay for those things. You've had relationships with other business partners in the past. Perhaps the industry as a whole has seen some technological innovation and the competition has brought costs down. Maybe you've got some negotiating power, some leverage that you maybe didn't in the past. So reevaluating costs that you've got from an operating expenses standpoint can be something that your income statement can help point you towards and give you some ammunition to be able to complete. We also want to mention financial ratios as associated and can be products of the income statement. Things to consider on that front are your gross profit margin, your operating margin, and your net profit margin. Each of those ratios can be really beneficial in developing a better understanding, depending on your situation and what you're wanting to do, to inform you better and make better decisions about the business and the outcome. So the income statement, as a conclusion, it's a very valuable tool in determining your business's profitability and validating that profitability to a lender when it comes time to borrow money, or potentially even positioning yourself into a better tax situation. It's a great tool to use. Thank you for your time.